Hello, and welcome to the February 2025 edition of the U.S. Energy Insights. I am your host, Pamela Munger, and I'll be looking at the latest trends and market conditions within U.S. and global energy, and sharing actionable insights powered by Vortexa's tracking analytics. In this insight, we will touch on OPEC versus non-OPEC seaborne crude exports, tariffs and sanctions impact on flows, Atlantic Basin refined product imports. Now let's take a look at where we are in terms of global crude and condensate exports. Global crude and condensate exports started 2025, continuing the trend seen at the end of last year and ended January at 40.6 million barrels per day, the highest monthly level seen since May 2024. Now, unlike previous months, where non-OPEC plus producers added rising volumes to global supplies, January saw combined OPEC plus exports rise month on month for the first time since October 2024. Increases were observed from Iran and Saudi Arabia and Kazakhstan, which more than offset a string of smaller declines from other Middle East producers, including Iraq, UAE, and Oman. It is worth mentioning that Nigeria's exports also dropped month on month. Non-OPEC plus exports were slightly lower as US and Guyana saw increases, unlike the rest of Latin America. And despite the rise in US and Guyana, sharper declines were seen from Brazil and Mexico. Now, all eyes are on these Latin American grades as we draw closer to the beginning of March, where President Trump's delayed tariffs on Mexican and Canadian energy imports into the US will potentially begin. We already see interest from the East of Suez buyers on alternative crude sources that could be used for the US refiners. Now that brings us to look at India's crude imports and inventories. After January 10th, OFAC sanctioned over 100 Russia-affiliated tankers, causing a readjustment of flows from Russia. And while weekly import data and export data shows an unusually low tally for the week right after the OFAC sanctions were announced, exports did climb in the following weeks, ending January higher month on month. We have also seen India's floating roof crude oil inventories in January at multi-year lows, moving lower, especially in the second half of the month, as indicated by the red line in the left-hand side chart. Now, this downward move in stocks is likely indicative of a need to draw upon storage amid short-term logistical constraints. India has been running their refineries hard, taking advantage of strong demand in the East of Suez region, while poor demand in Europe continues to keep the arb closed. India's historically low stock levels could also reflect an increased need for alternative imports, at least in the short term, as can be seen in the stacked columns where we see increased level of crude imports, especially from Saudi Arabia and Ecuador. This is significant to the US refiners as they look toward alternative crude sources in the light of looming or delayed Trump tariffs. Now let's take a look at China's oil and gas supply and how it may be impacted by recently implemented retaliatory tariffs on US crude and LNG imports into China. The most recent tariffs applied by China include 10% tariffs on US crude and 15% tariffs on US LNG, effective February 10th. This has impacted around 2 to 4% of China's crude and LNG imports, as you can see in the red lines, which show the share from the US. This is a relatively low share, and these imports can easily be redirected to other buyers. Now, a much bigger risk for both China and the US is the risk for China to apply tariffs on LPG and ethane imports from the US, which would likely crippled the petchem industry in China, especially in the Shandong province. The US is a main supplier with around 80% of LPG imports in January. Recently, we are hearing more news on the likelihood of tariffs placed on the European Union. Now, although energy imports have not been mentioned yet, we can see that the US, namely PAD 1, is highly dependent on the EU for gasoline imports, especially amid possible tariffs on its main waterborne supplier, Canada. As Europe imports large amounts of energy from the US, as seen on the right-hand side chart, there will be much at stake for both sides. Ahead of the tariffs, we can see PAD 1 suppliers upping the waterborne imports from Canada's east coast for much-needed diesel after the recent cold snaps have left inventories at the bottom of the 5-year range, according to EIA data. And as we look ahead towards gasoline season, which will call on much-needed fuel oil for US Gulf Coast refineries, we see that recent import volumes have fallen below the seasonal range. There have been reports of refineries running their FCCs at lower rates upon disappointing driving season from 2024. And lastly, we take a look at the West African import market, which is now receiving stable and ample supplies from the Dangote refinery, making West African volumes surge within the region, which continue to back out imports from the region's historically dominant supplier, which is Europe. Well, that's all we have for you today. Thank you for watching and hope to see you on the next edition of the US Energy Insights.